Hello and welcome to the Monday Futures Market Outlook for May 28th, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a chart of the US dollar index futures, and we are clearly still in trend with last week the US dollar breaking to higher highs. That US dollar index actually moved higher largely because of not only the euro but a number of other currencies, including the Canadian, the British pound, and so on, that really gave it a thrust higher, and that is now consolidating at higher highs. At this stage, even though we do believe that there's room for the dollar index to even go as high as the 84, 85 level on the upside, we don't believe it has to get there in a straight line. While we wouldn't rule that out, more than likely there will be probably a couple periods where we'll have some consolidations, whether they last a week or two, or whether we have even a full retracement down toward 81 or 80.50 before it reverses back up is unclear at the moment. But at this stage, we do believe that this trend is in place, and it is not going to reverse into a new US dollar bear market anytime soon. Next, I want to take a look directly at that euro currency and see how the euro is trading. We can continue to see that the euro is consolidating at lower lows at this point, just like we're seeing that US dollar at higher highs. At this stage, the euro over the last couple of years has put in key bottoms around that 120 level, and it certainly at this point feels like the euro is going to head down and test that 120 level on the downside. Really at this stage, though, again, just like what we were suggesting with the US dollar, it doesn't necessarily have to go down there in a straight line, and we could be looking at small pockets of even a week or more where the euro just does absolutely nothing, if not slightly rallies. But in the bigger picture, we believe a downtrend is very much in place, and there is more room on the downside for the euro to finish this move. Next year, I want to take a look at that 30-year Treasury bonds, and they have been consolidating up here after having a substantial breakout on the upside. Really, at this stage, we believe that it's more than likely that almost all selling should be contained to that 145 to 146 zone down below. Even if there is a shorter term, a little bit deeper consolidation at some point, it doesn't change the primary trend. What's occurring right now is a lot of money is leaving a lot of international investments and finding safety in a strong US dollar and a strong bond market, and so the money is naturally flowing here. This is a trend that again will probably stay in place until everything in the Eurozone is resolved. Next year, I want to take a look at copper futures, and copper is certainly weakening as the U.S. dollar is strengthening in this cycle. While again there could be small consolidation points, we do believe that there is room for copper to go and retest all of those lows at the $3 and the $3.20 level, where the lows all came in October, November, and December. So we'll be watching simply for opportunities to get short copper on short-term rallies. Next year, I want to take a look at the chart of the E-mini crude oil contract. We continue to find support initially at this 90.92 level, and again, this after such an intense wave of selling, it certainly wouldn't rule out the possibility that we're in for some sort of a good crude oil bounce back to $95 or $98. But at this stage, if the euro continues to weaken throughout the early part of the week, and we continue to see the trend of the last couple of weeks stay in place, there is a possibility that we could see this crude oil contract break the 90 level and look for support, maybe even down as low as the 85 or 80 level on the downside. This trend very much is in place. We are, in general, bearish commodities, so we're simply pointing out there could be short-term bounces, but in the bigger picture, we still are looking for weaker crude oil prices. Next year, I want to take a look at gold, and gold has now properly retested that 1540 to 1560 level on 2 occasions. In the bigger picture, there is distinctly a distribution cycle going on in gold, and we don't see that coming to an end here, but there definitely continues to be room for short-term bounces. It wouldn't be surprised if gold, copper, and crude oil all bounced at the same time at some juncture over the next couple of weeks. But if we did see a bounce, we could see gold temporarily trade up to 1610 to 1650 on the upside, but really at some point gold will likely still head lower, and we could see lows even later this summer, even as low as 1440 to 1460 or lower. That brings us to looking at the S&P 500, and as always, we start off with a weekly chart going back almost 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. We just now, as we trade here at this 1300 level on the S&P, we are literally just 20-30 S&P points away from that moving average line. It's interesting because during the last decade, every time we've tested this zone and it bounced, it became a buying opportunity in the big picture. And this is going to be an interesting thing as to whether or not the S&P really will hold these support lines, in this 1290, 1280 area. In the bigger picture, obviously, short-term breaks below could happen, but in the bigger picture, we can remain positive on the market so long as we stay above these zones. If we see any substantial deterioration below the 1300 level with sustained selling, then it may have actually begun a new sell cycle that could be more prolonged and deeper correction. So we'll be watching whether or not in the upcoming weeks or month or two we do have a full violation of this. When we take a look at that S&P 500 on the daily charts, we've now tested that 1275 to 1290 level on the downside. We're now creating a flagging formation that could have the S&P even go as high as the 1340, 1360 level. And while we certainly can't rule out some short-term strength in the S&P, we do anticipate there still to be another round of selling. The best case scenario for the bulls is that another round of selling simply double bottoms at the 1275 to 1290 level, or even if it a very short term drop down to 1240 that immediately gets back above 1280 within days is also acceptable from a technical perspective. It would only be really seriously sustained selling below that focal point that would really be far more concerning for a much bigger picture correction on the downside. So let's watch where the S&P finishes this upside consolidation and whether another breakdown move is imminent this week. When looking at our key intermarket observations, the U.S. dollar remains short-term and longer-term bullish at this point. We have changed our outlook on the short term to reflect the fact that it has broken to higher highs, but want to just simply point out that that doesn't mean that the U.S. dollar isn't going to go through a short-term little consolidation absorbing the last move, but we're simply identifying that a trend very distinctly is evident in the U.S. dollar. In the same regard, almost all the commodities are distinctly bearish, as we are seeing not only on daily charts but weekly charts, all the sell signals coming across there. Bonds remain relatively bullish. Again, on the very, very short term, there's room for pullbacks and consolidations, but we definitely have a daily chart and weekly chart trending. And on stocks, we are obviously bearish on the short term, but we remain relatively neutral on becoming longer term bearish at this stage. We believe that S&P support line is a very important one, and so long as stocks in the bigger picture hold above there, then we have room for the market to actually hold up and stay within this area, and potentially later in the fall become bullish off these levels. But in the same regard, if we see anything that substantially deteriorates below that 1275 to 1290 area and holds down there, we would become longer term bearish on the market. That was your Monday Futures Market Outlook. Thank you for joining me.